listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Luongo.
All right, everybody. Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Luongo from the OptionsInsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. If we sound a little bit different, it's because we're not coming to you from our studio in Chicago. Nope, we're coming to you from the Options Industry Conference here in sunny Florida. It's a great event because it gives us a chance to catch up with a broad cross-section of the industry, including our next guest, Pat Luongo. He is the director and head of AES Options Sales over there at Credit Suisse. First off, am I pronouncing your last name correctly? Is it Lingo? Is it Lango? How do I pronounce that?
You nailed it, Mark. You're familiar with that name.
So first off, the first and most important question, how did you get such an awesome last name? That's the real thing I want to know.
Well, it starts with a strong family, so and the roots go deep, as you know.
The name is just commanding. It really commands the presence in the
punchy.
Room. It is. It has a ring to it. I like it.
Yeah.
I may have to borrow it someday. Let me just
I'll give you the rights.
Okay.
Yeah.
I'll do a different spelling maybe so that everyone there's no trademark.
Just so nobody,
there. Yes.
because we're two, obviously legends in the business. So,
Well, Pat, as we are wont to do with all of our first timers on the network, why don't you go ahead and give us a little bit of an overview of your background in the space and how you found your way over there to Credit Suisse?
Yeah, thanks, Mark. I appreciate the opportunity to be on finally after a few months of wanting to be on your show. So I started the business in 1993 on the American Stock Exchange. So I started out as a specialist clerk for Spear Leads and First Options.
Be out there in Intel, that was their big pit.
Oh yeah, well I'll get to that. There's definitely a story around Intel. So around 1995, I joined a firm called TFM Investment Group, and they were a medium-sized specialist firm based out of Philly that were branching out to the three other exchanges at the time. And Amex was one of the exchanges that they sent representation to. And I latched on to a team there, and they gave me the opportunity to learn the trading side of the business and eventually hop in a crowd. So that's what I did, and probably the best experience at the time of my career was trading Intel as a market maker. And then as the exchanges expanded into offering dual listing in the options, that gave our specialist book an opportunity to grow. So that came with a lot of allocations, dual listed products, quad listed at the time then, and I moved over to the specialist side of the business. So I did that until we were acquired, I think, in 2001 by the entity which was known as Spearhall Derivatives. So Goldman Sachs came in, bought our group. I worked for them for a few years as a specialist. And I found my way to the electronic trading side via Credit Suisse about 10 years ago.
It's interesting. I a little bit different path than you because I was at the SIBO, and then when all the multiple listing happened, I went out into Intel. I went the opposite way. I started in the SPX and went out into Intel. There were some fun times. People sleeping over at the exchange to get the first spot in Intel, fistfights.
Oh, yeah, I know all about that.
The heady days of multiple listing. Those are fun. We also hated you guys at the Amex because you guys were the main pit for Intel.
We were an easy target.
We were trying to break in. It was kind of like the opposite of IBM. Obviously, was the big dog.
So we competed against each other.
Probably.
There was probably a Longo versus Longo trade, right?
I probably cursed your name a few times without even knowing it. Curse that unknown relative on the...
Yeah, my name was cursed a lot of times, I'm sure. So,
well, obviously, a lot has happened since the crazy days of multiple listing. Walk us through. What are you doing over there these days at Credit Suisse? What's your day to day? What is the head of AES Options Sales up to?
Sure,
at Credit Suisse?
yeah. So I run a small team, electronic options agency business. So we're part of the AES Advanced Execution Services brand. So we're very large in the equity space, and our asset classes talk about equities, options, futures, and FX. So I'm fortunate enough to be part of that brand. Also fortunate enough to be part of our derivatives team. So Credit Suisse obviously is a large player in the derivative space on the both high touch and low touch. So I'm able to take advantage of being having the resources of both the electronic brand and our derivatives team at my disposal. So we basically cover a global client base, and anyone who wants to come through Credit Suisse and access the U.S. listed options markets electronically would come through my desk. So we're a provider of options electronic strategies for both single and complex orders, including delta hedge and volatility strategies, to buy-side firms, sell-side proprietary shops like hedge funds and asset managers, and proprietary trading groups, market makers, et cetera.
It's an interesting time to come on the show. This is much more upbeat conference. I'm not sure if you were here last year, but much more dire.
When
event.
Vol was
volume,
9?
Volume was nowhere to be found. Vol was nowhere to be found as well. A lot of hand-wringing about where's the future of the business, what's going to happen. This year, of course, Vol came roaring back to life. Volume up so far year-to-date somewhere around 30%. That's probably not sustainable for the entire year, but still not a bad start to the year. So I'm curious, what has the last few months been like for you over there at Credit Suisse? You guys obviously have big hands in the derivative space and the volatility space. We've seen a lot of action in both of late. Walk us through the last few months.
Right. Yeah. Well, from our perspective, we've obviously welcomed the change in regime in volatility, and it's obviously been a little bit of an awakening for our clients who got used to a stagnant vol environment, a very low vol environment. I believe 2016 was challenging because I think we've seen these low vol levels for a few years, and talking to clients and asking them why they're not trading as much. I think there was a lot of over trading a few years back, and they don't obviously performance plays a huge part into their relevancy. So when 2018 started with a fresh look on the markets and a lot of macro events that played a role into the increase in volatility, and with that came a spike in volume. So we obviously welcomed that regime change and that higher volatility, and we're still enjoying it today.
A big theme of the conference this year is liquidity and some of the concerns people have therein. In fact, we polled our audience before we came down here, and we said, what are some of the things we should have at the top of our agenda? And pretty much half are saying, liquidity should be at the top of the forefront. Now, you're someone over there at Credit Suisse. You have to execute in this environment. I'm curious, is this a concern for you guys over there as well? Have you been encountering this dearth of liquidity? And if so, what do you think we should do to try to maybe correct it?
I'm glad you mentioned that, Mark. We obviously talk to our clients a lot, and that's part of our role is selling our platform, selling our brand, selling our bank, and selling our services. But we feel like we reach out to a very broad audience, like I mentioned before, and part of our job is to find out what's really important to them. As a strategy and algo provider in electronic options, we always want to make sure that we are providing our clients with the tools that they need to execute efficiently in the markets, and I would say liquidity is probably the number one. I guess liquidity is the most important factor in them determining how they execute in the market. So we're an agency broker, like I mentioned. And we're connected to all currently 15 exchanges right now. We utilize our smart order router to find liquidity, and also in complex orders is by fragmenting our orders out to multiple complex order books, we're able to seek all the liquidity we can for our clients, and giving them the right tools to seek that liquidity. Beyond that, obviously having a stable system and the technology that needs to be constantly put into the business to maintain our stability and our efficiency in the markets is important.
You mentioned the multiple complex order books. We have more coming to the fore soon with the addition of number 16 coming to the space, and I believe sometime in Q1 of next year. What are your thoughts on this continued fragmentation of trading venues, and perhaps if that's indeed even driving this liquidity issue everyone's so concerned about here at the conference this year?
Well, for us, we really don't have a choice. We have to connect to the exchanges. We have best ex obligations for our clients, so we should be connected to any new exchange day one. It depends on who you ask internally, depending on the reaction that you get. It's definitely a resource constraint for us by allowing having our developers use their resources to connect. But ultimately, if more fragmentation for our clients and seeking liquidity in different ways is good for the markets, then we're going to welcome it. The question, I think, is, does a new exchange bring incremental liquidity or more participants into the market? And I don't know if we've seen that. We're kind of stuck in this $4 billion contract a year realm. So we're seeing a spike because of volatility, and fortunately we got out of the gate strong. I think we had the best quarter in history, which is very good for our business, and the exchanges held up really well. I guess the way they view it is, if it's not a huge cost to them to leverage the existing technology to roll out another exchange. You never know, Mark. Is something new can come our way, and it can be sticky in our business, and as we know, sticky's good.
For you guys, obviously, it could be a boon. People need help migrating and navigating these multiple exchange markets. So for you guys, probably 100 exchanges would be let's over there. Maybe
let's not go too far.
Let's cap it at 50. How about that?
We'll put a cap on it.
But another interesting talking point at the conference here this year is the kind of the counterpoint of that liquidity discussion is the fact that there are fewer firms out there to really provide that liquidity. You were a market maker. I was a market maker. We both have that former attached to it now. We both have left the business, and we're far from alone. Most of the people who were market makers have left that business and did so for a variety of reasons. I'm curious, you still engage with a lot of these firms out there. You're at the conference here today. What do you think we could do as an industry to maybe, if not reverse the trend, at least stem the tide a little bit and start to stop the bleeding from people leaving the space? Well,
we have to just incentivize the market makers to to keep participating and providing liquidity. There's a lot of talk about strike listings, and this is the perfect forum to address a lot of these issues. And I think what we really need is harmonization amongst the exchanges to work together to figure out how to improve conditions for market makers to provide good markets and tight markets, and to maybe just not be held to quoting and all these strikes that don't really trade and that are really irrelevant. But I'm in a difficult situation when it comes to that, because I'm constantly asked by clients to add more strikes and get more strikes listed, and I'm always reluctant to do it because I'm very involved in a lot of these discussions about what is wrong about our business, but I also want to make good by my client to know that we have the resources to go out and try to get them what they need. So I just think the industry as a whole has to come together to make sure that market makers are benefiting from all the current market structure setup.
We've had a lot of people in here, exchanges and other firms, talking about something similar, about maybe finally taking some action, quote mitigation, delisting, or maybe making an RFQ for some of these less liquid names. Is that something you guys would be in favor of as well?
Well, we have to give it some thought. Certainly, if it benefits the industry, then we would be for it. Anything preliminary, making a judgment call on whether we would be for it or against it would be premature. But, obviously, I think, we talked about this before, Mark, and a lot of people that are on the exchange side or involved from the OCC side, there's a lot of former traders and a lot of people who got their hands dirty in this business and understand what the implications are on, from the time someone sends an order to the time it's executed and cleared and settled. So I think we're all experienced enough in this business to come up with the right solution. And, obviously we would like to be a part of that discussion.
Let me ask you something else. It's a hot topic for our audience. It seems to come up around this time of year a lot, which is typically earnings season. Particularly a lot of the retail seem to be interested in it. In fact, it's coming in number 2 on our poll right now with 37%. They want us to talk about after-hours trading for options. And, you probably see this a lot with a lot of customers this time of year. They buy a call and pick your tech name, whatever, Amazon, Google, Facebook, whatever. It moves 100 handles in the after hours. It opens the next day, unched. They're outraged.
Be careful what you wish for,
exactly,
right? Yeah,
exactly.
Yeah,
then they write a letter to me and they're angry. I can't do anything about it.
Right.
But they let me know anyway. And so I'm turning the tables to you to see, what are your thoughts on this? This is an issue that's been bandied about a lot. People seem to be pretty split on it. Do you think this is something we could reasonably do in the options market in 2018, or is it way down the road?
I think it's a little way down the road. From my perspective, obviously wearing a lot of different hats, we have to look at this view many different ways. So the first thing that comes to my mind is if we can ever come up with some type of connectivity to this is dedicating the resources to do it. There are, a few other facilities out there that allow for, pre-market trading and the problem is obviously if you build it, they will come, but sometimes they don't always come in case of extreme volatility. And like you mentioned, people only wanting to do this during an earnings cycle. I think the jury's out on probably after hours trading. So for us to commit to something like that, there would obviously have to be plenty of liquidity and us to be able to justify to provide the resources to make it run, to make it functional, and that requires having the right developers in place, compliance, sales staff, trading, coverage, etc. So we would have to probably take a wait-and-see approach on that.
Well, Pat, I'm glad we could finally get you, my forgotten namesake here, on the network.
It's a great name.
It's served me well. I'm glad to see it's working pretty well for you as well. But before we go, maybe there's something we didn't hit on, or maybe you want to leave our audience with a little bit of a hint, a little bit of a tease, a peek behind the scenes of what's coming down the pike from Credit Suisse. Now is the time. The floor is yours.
All right, great, thank you. So I think what you can expect from us, at least on the electronic side, is we're always listening. Again, I mentioned we listen to our clients, and we take a lot of feedback from our clients. So there are some strategies out there that we have in the works to for both single and complex orders to try to do price discovery in different ways. So whether it's a tweak to an existing tactic or a whole new tactic from the start, you'll see something soon from us on that side. Other than that, we're always looking to explore different venues, and especially on the complex side, enhance our delta hedging capabilities. And we always talk about cross-asset hedging, which comes up a lot with our clients since we provide electronic execution in so many asset classes.
Well, Pat, like I said, it was great to catch up with you, and I look forward to seeing how some of these hints and these teases unfold in the marketplace in the coming months.
Yeah, thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.